Private credit, we're going to talk about how it's going head-to-head against some investment banks for some of the biggest deals. According to a new study from Lincoln International, the two have been trying to beat each other out on pricing and terms across the direct lending landscape. And for more, we're joined by Bloomberg private debt reporter John Sage. When you look at the data that we're getting here, you're seeing compression. So that signals that the glory days are coming to an end, doesn't it?
Absolutely. And you can see that very directly, obviously, in pricing. But another great thing to call out that the report calls out is payment in kind being offered in a lot of these direct lending deals. And that's something that the broadly syndicated market can't really do and hasn't really wrapped its head around yet. So private credit is saying, sure, now that you're coming back, you're able to offer lower pricing in the broadly syndicated market. We're able to offer these payment in kind where you don't have to pay interest or all of the interest on a lot of these deals. So they're trying and pulling their levers to find ways to stay competitive as well.
Give us some examples of what we're seeing in the market here on deals that are coming to market, because even the ones that direct lenders are dealing with, it seems that you're seeing some spread compression here.
Absolutely.
Meaningfully.
And Iris Software is a perfect example of that. It's a KKR acquisition, and we're seeing potentially one of the lowest pricing spreads in the market as it currently stands. So that's a great example of that. Or RL Datix is another great example of that, where it sits right on the periphery of both potentially going to the broadly syndicated market or staying in private credit. So the private credit tiers out there are saying, well, we'll lower pricing as much as we possibly can, offer these different small little tips and tricks and little things to make us stay as competitive as possible, but it'll need to be seen for with some of those deals and even more deals out there, who actually is going to win out.
I think one thing that's important too is you were talking about terms, PIK and others. Does this create some concern about the quality of credit that is coming to the surface and potential erosion of returns in the future? Even though you see returns beating buyout funds, if you start losing money on these current deals, then what does that mean?
Sure. And you see a lot of these covenants, which are the most important thing for a lender when it comes to keeping your investment safe. You're even seeing some of those start to fall away, especially relative to the broadly syndicated market, where we haven't seen covenants in many years. So private credit, again, is saying, well, let's be competitive and remove some of these covenants, even in the lower end of the market, which traditionally has always had at least 1 to 2 types of covenants. So as you see that start to fall away as well, the long-term potential is, hey, if I don't have a covenant and something goes wrong here, what's the potential risk to that is much larger, much greater.